All right, so it appears that traders are kind of getting this kind of collective with what we're seeing with the S&P 500. There was a very obvious resistance level. We screamed to the upside to get to that resistance, and now it looks like we've been unable really to get through that resistance. We might have gone up a little bit too much too fast, and probably spent a couple weeks worth of move last week, and now run out of gas. As everybody sees. Again, it also appears there wasn't a whole lot of like potential energy built up in the bearishness to propel us forward once it got converted to active buying. And so I'm going to break down kind of what the charts are looking like and you know, again, what my expectation is going forward from here, and how that aligns with what we've been expecting already. See if anything has changed. And then we're also going to take a look at what's driving. There's a rare pattern today when you look at how different asset classes perform. So I'm going to break that down, what it means and why it was so rare. And then we're going to take a look at what's our trade idea of the day. Is a stock that's been really bullish. One of the few sectors and areas of the market that have just been screaming to the upside. But it also appears to be kind of following the market's pattern of rolling over. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, June the 1st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started with our market forecast chart, I invite you to subscribe to our YouTube channel, hit that thumbs up icon down below, comment on the video. You can join our website at MarketScholars.com with that link popping out up there in the top right corner of your screen. Like us or follow me on Twitter for more content between the videos at DavidSettle42, and join our Market Outlook Facebook page that we've created. We also invite you to like us on Twitter and Facebook. 115 likes goes, those go a really, really long way for us. So that's why we always ask. So thank you for those who do it, and let's see if we can top that 115 mark tonight. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had light green shading in the yellow line over the last couple of days, and now that's played back out into a red line as we're back below the moving average, just barely though. We just barely got up above it. Not enough to really change the trend. Though we did get a new that near-term peak getting above the 90th percentile is very good sign. You know, again, similar to here, it just didn't stay very long. We're already out of bullish territory. Now, you have to get into bearish territory to end this run, because we can bounce right back up and still be on this near-term rally. So, you know, really important to see what we do, as an intermediate line is above its market sentiment that's still falling. But the intermediate line, again, is still just barely out above 40. So we really needed to get, if you're going to be bullish, right, we're going to need to get above 50, get into bullish territory, keep this near-term line running. We don't, like something like this, you know, okay, it's okay to drop, but as long as it bounces back, even over here, you can see it was okay to drop, but then it bounced back up without getting in the bearish territory. You'd like to see a good, long, near-term rally to start an intermediate run, to get that intermediate line from bearish territory to bullish, you know, and again, above its moving market sentiment and all that. So really important next couple of days here. My expectations are we're not going to rally, but if we are, that's what's going to happen. That's how it's going to happen as we head into Thursday, tomorrow, and then Friday. So really important next couple of days by the end of this week here as to whether or not we're going to reverse lower and fill in some more gaps like we did today, or reverse back to the upside. This is a bearish candlestick pattern, so this is kind of a quasi evening star candlestick pattern. As we mentioned before, for some reason I must be deleting these. Let me redraw them. But here is the current market sentiment decline that we're on right now, and of course, here is the current intermediate line that we're on. Intermediate pulse, so you can see where the resistance is, and that's basically where we got up to. Another really important line. Let me draw another really important line here. I'm going to draw from the bull market low point here. Let's see, that's the that's the one that we're on right now. So this one is the one I need to edit and make this one red. So this is the whole bull market that we've been in. And then now let me draw from the last correction, right, from the prior correction low point down here up to now. So let me get that up there. So make sure I got it at the low point there, and make sure I got it at the high point up here, which doesn't look like I do. Get up, there we go. So the black line being the post-COVID rally, so the move off the last correction low, and then the red line being the move off the last bull market low point, which you notice right here is that red line right at the low point. So you see how important, like, we haven't broken that. Now we have on the NASDAQ. If I were to draw the same lines on the NASDAQ, and I have to go out pretty far here, so let me just go out to a monthly chart here, and then I will draw the lines from that low up to this high point and make that one red as well. This is again the last bear market low point that we've had was that 2008 level. And then the last correction low was coming off the COVID, so that's the black line here. Let me make sure I get this on the actual high point here. There we go. There we go there. So you can see the red line right there. We did break below that line, and it makes that level even more significantly resistance. Like the resistance that much more significant, that much stronger. And it's just going to be really, I mean, that was just not here. See, we got to the 23% line of the bull market run, and we bounced off of that. No resistance. We got right back above that 23% line. Okay, great. We didn't quite get back above the 78% line of the market sentiment decline. Okay, here, let me get rid of this one now. And then we dropped, right? And then we dropped back down. We broke through that 23. So we have broken through it on the NASDAQ. We have broken through it on the Russell 2000 as well. When you look at it again, that same bull market low point from way back over here all the way up to this high point. And again, we'll make that one red too. Red right there. And go back to a daily chart. So again, we have broken that line, and it's sitting right there at that 62% of trade. You see how significant that resistance will be. The 38% of this market sentiment decline, this one here, the 62% of this current intermediate decline, the 38% of this post-COVID rally. It's all in this area. It's all very hard to get through. But the reality is the S&P is at this stage. So the S&P is we've just tested. We barely just touched that 23% line. The Russell and the NASDAQ have broken through, which means more than likely the S&P will also break through, as it typically follows suit with what we're seeing in the other line. So again, another reason why don't get too worked up about these rallies, especially considering some of the factors we've been talking about. If you follow me on Twitter too, I posted last night a series of charts to show you this 5-day rally that we've had. Here, I'll go to it. And again, if you're not following me on Twitter, I do post quite a bit of stuff here at DavidSettle42. The more you like the post that you see, the more that Twitter will keep showing you my stuff. So that's how you can make sure you still see all my content. And I put out quite a bit here. But if you go down, I did this last night right here. I released this thread that has these replies on it. And so here's the current 5-day rally win streak that we had that everybody got really kind of excited for here lately. Along with the volatility picture. This is the volatility picture coming off at the lowest point, right? Before the 5-day rally. This was the volatility picture that produced the 5-day rally. Right? So now when you look at some of these, here's the same pictures off the 2020 low, the 5-day rally off the 2020 low, and the volatility picture at the low, the 2018 move, and the 2015-16 move. And you can compare all of these to what we're doing right now and see that, you can see why it's not very likely that we're going to get the same kind of correction bounce, because I don't believe that this is the correction low yet for a multitude of reasons. From a weekly standpoint in the market forecast, remember we do have 2 days left. The near-term line did, so last week the near-term line got into bullish territory, well almost at 59. This week, without a significant reversal, and really not a whole lot of follow-through either, but at least the near-term line did get into the upper reversal zone. So now the question is, will it do what it did here? And just stay there for a couple weeks instead of a good chunk of time? Will it just stay there for a couple weeks and come right back into bearish territory? and get the, and be bearish, or can it stay here and get that intermediate line out? Because that intermediate line it's not very common. As you can see, the COVID intermediate line didn't get down into the reversal zone. None of these others, the 2018 got down there for what? 1, 2, 3 weeks was the 2018 correction low. The intermediate line got there on the weekly. It did not get there in 15, 16, did not get there in 2011, nor did it get there in 2010. It was the initial correction low that started the bear market that we were down there at this level. So, it goes to show just how rare this is. And this also kind of goes to show that, we might not be done here with the declines. And like I said, I don't even know if we're necessarily done with the correction low point. Here's the other weekly chart. It is a bullish week, a bullish candle after a big transition candle last week. It's a really good sign to get a bullish candle. The Heikin-Ashi differential is positive. This isn't the first time. We got a green arrow here. We had a rising PPO there that was still positive at the time. I mean, things looked okay, but again, failed pullback bounce. And now, is this going to be more than just a 1 week deal? The PPO is still falling. You don't have the green arrow. So we'll see how next week's candle shakes out here. You can see next week's open, as of right now, in the Heikin-Ashi candle will be about 40.78. And we're trading at 41.01. So it's going to be a really small body to start the week next week, depending upon how we finish, of course, this week. The other thing I wanted to point out is that hull. You can see, so we did not get a close above the prior week's high. You typically get good, just like the last few days, we've been getting some good bullish closes. Not yesterday, and today we actually got a lower close and a lower shadow. So we got a little bit of a transition candle today, and you can see the PPO here, the histogram, which is about as big as it was here, is already rolled over. Which is the PPO right here in green, without getting above a 0, has already started to decline too. And it suggests that we may be kind of hitting up against some resistance here at the 200-day hull moving average, which is still red and still moving there to the downside. Let's take a look at some of the other oscillators. The DMI chart, you can see the negative DMI, the directional index, excuse me, did dip its toe below 25 only, and now it's dipping its toe back out. So it hasn't really stopped its move to the upside. You can see down here it actually got below 20 on that rally, and it did dip its toe over here on that rally too below 25 just to turn back around. Same thing with the positive indicator. It got above 20 and turned back down. It did that here too and rolled over, and here we are again. So let's see if it rolls back over. If we can get ideally to turn this around, we need to get this above 25 and the negative below 20. That's not a guarantee, because that's what we had here, but at least you at least need that to turn things around. We don't have that yet on this particular indicator. Let's look at the RSI and the CCI. Again, you're above 100 still, you're above 50 still, but just barely hanging on. We need to do more, right? We need to get above 60, and the CCI needs to get about 150. That hasn't happened for quite a bit of time. All these other times you haven't, this is the last time you actually got both of those signs, and we haven't had one since, despite these supposedly really good bullish rallies. When you look at the stochastic chart here, here's another indication. You can see, we did get above 50 on the SPX. We are in the upper half of this chart. That's a good sign. But like this period here, not so much here, but like this one, it didn't quite get it, and stay above 60 and turn back down. And that appears to be the case again so far. Now the orange line is coming up from a much lower level than we saw there, but it's still easily in bearish territory too. So we're not out of the woods here in the least bit, and especially knowing that we have so much, pretty darn strong resistance levels in this area between the green 38 and the orange 38. Because remember, that's where the red lines are in that spot, or there's some other resistance. The volume profiles in that spot too. Let's take a look now at the Ichimoku cloud. We are still easily below the cloud. We've been below the cloud this entire green run. So this green run is this rally. So, if we're going to be bullish, by the time we get to the green, we need to be above it, and we weren't. Now we're to the pink, right? So by the time we get to the pink, you'd like to be above it too, over here, because that's this decline. So that means we've bounced back up, and we're not. So far we're below the pink. Now we've ended, these last 2 days, we've ended the bearish run. So that's a good sign. We had a strong bearish run and it's ended now. So we're down to 0. So we have no trend going, but again, a reversal pattern, evening star candlestick, engulfing Harami's, with engulfing, that's a reversal candlestick pattern there that we'll keep our eyes on going into, you can see some of that resistance. There's that value area, the bottom of the value area there, right there at about, let's see, where would that value area be? Right there, 418. So it's sitting right on those same levels, the 23 black line, the 38 orange line, and the 38 green line is just right below it. So you're sitting right there at that resistance for multiple resistance levels. The bandwidth is falling as we expected it would. We did not get into the upper quartile. We're still in the upper half. We did not get in the upper quartile. Let's watch to see if what happens as we get into the lower half. It's actually something I expect that we'll ultimately do. Let's take a look at the intraday moves, and this is kind of telling too. So when you look at this intraday move here, you'll notice that we did fill in this gap. So we had 2 days in a row last week where we had gaps that we opened with and just ran away from. They weren't big enough to be really a runaway gap, but we filled in this one already. So this one right here, you can see we've already filled that in up to, for the most part, up to today's low point. And we did rally back above before the Sandberg news came out with Facebook. We did rally back up above yesterday's low. So lower high, lower low, but not as bearish because we closed above the prior day's low. But that was until that last, in this case, 10 minutes, where we got that Sandberg news out of Facebook, Sandberg leaving Facebook there, and it pushed Facebook down and brought, again, of course, because it's such a big market cap, brought the broader market down with it. But we still have this gap to fill in. That would be considered a common gap. That gets us down below 400. So that's something to keep an eye on too, as to whether or not we'll get another, continue with the lower highs and lower lows going into tomorrow. You can see the histogram on all these charts. Let me go back here. So we don't have the green. We got green shading for what, 1, 2, 3 days. Green shading for 3 days. You got a red arrow now, so now we don't have the green shading. The same thing here. We got the red arrow there. You came really close to a red arrow there, really close to a red arrow. We never did get the green shading on the Qs. So, and just like that, your histogram's already rolling over on all of them. So let's see. Now we've had that. So 1 day doesn't quite do it, but the fact that if this is it on the green shading, if we only get a couple of days of green shading and this red arrow turns into now the lack of green shading, that's a sell signal. 3 red arrows is a sell signal, right? In this case, it'd be 1 red arrow, but that's that light green shading in the yellow line. That's a sell signal, and that's what we got. Especially, like I said, if this stays, and again, I expect that it will. When you look at today's volume, it's below average, 86 million. The range was also below average at 9 points, so hardly the kind of breakout moves to the upside that you'd like to see. 86 million is down here, well below the average. The 9 points is way up here too. It's still pretty high. You're at almost at 2.5% still, so you still have a very high ATR. But despite that really high ATR, you have a really low VIX. So like the VIX is really low for as high as that ATR is. In other words, this, if I go to this, let's see, where is it? It'd be this chart, not that one, this chart here. That's a pretty sizable gap between the historical volatility and implied down here. That typically is a sign that we are hitting a correction low point. But the problem is, according to the ATR, the VIX is still too low. It's still really, really low. And not only is the VIX low on an absolute basis for how big the ranges are, but it's also really low on a relative basis, right? It's still well below 95% of the VXV, which means that VXV, as high as it is, the VIX should be a lot higher, right? Because usually when the VIX 3M is up to these levels, the VIX is higher, much higher than this. So it's not very common for the VIX, for this to get up to 30, to be above 30. Just to kind of give you an idea, I think I showed this, but let's go to a weekly chart. So here's, going back to 2008, it's not very common for this to get above 30. much less above 40 if I were to draw another line. So let's do another horizontal line here. And I'll do a 40 on the VIX 3M. And let's change that color to like red. Let's do a different color because I already got red and green down there. So let's change that one to, I don't know, purple. Okay, so there's 40, and you can see like we have the bear market low point, like the worst of the worst there, and we were volatile. That was October. For the next 3 months, 90 days, so November, December, and January, things were pretty bad. So that kind of gives you an idea of how bad things were. We never did. We got above 30, but not above 40 in that 2010 correction. We got above 30, but not above 40 in the 2011 correction. We didn't get above 30 in the 15-16 correction. We didn't get above 30 in either the 18 moves, the deep pullback or the correction of fourth quarter 2018. We got above 50 on the COVID because things were pretty crazy. But it came down pretty quickly, fell back below 40 pretty quickly. See, we stayed above 40 a good chunk of time there. That kind of shows the difference between the, a lot of people compared COVID to the 2008, but we stayed above 40 in 2008 on the VIX 3M for quite a while. We did not on COVID. It came right back below 40, eventually got back below 30. Brief little jumps above 30, but for the most part staying below it. But you can see how we're trending up. Higher highs, higher lows, and we're trending to the upside. Again, getting above 30 is significant, right? It's a very, very significant level here. Again, it shows more than just a correction, in my opinion. Even that first correction of 2008, VIX 3M didn't get above 30. So it goes to show just how bearish people are, because they're not just buying, the VIX isn't the one that's just as high, but it's the VIX 3M that's high, and the VIX is actually really low. So people are actually more complacent right now, considering how big the ATRs are and how high the VIX 3M is. Investors are actually pretty darn complacent, which kind of means that we're in a bull market within a bear market, right? To quote the tweet that I put out there the other day from Kramer, which has got to be one of the dumbest things I've ever heard of, that we're in a bull market inside of a bear market. But the volatility picture is showing you that investors are pretty complacent, even though there's still a lot of concern. What does that tell you? That tells you that we're not done. Like that's not how corrections end, with complacency. When you look at, I showed you this new highs index. It got above 0. We got it to 18. It got back. Now this is kind of preliminary, so we'll see by tomorrow if this stays here. But yeah, we're back just like that. You're back below negative. Look at the other times that we barely got above 0, but not above 100 from being negative. We were pretty negative there. I got above 0. We peaked, and you can see the drop that we had. We got above 0 right there. We peaked, did not get above 100, and then look at the drop we had. So I don't think we're going to get like these kind of drops, to the exact amount. But you can see getting above 0, but not above 100. Usually sets you up for a pretty decent leg to the downside until you finally break through 100, right? And you get to the upside and you get coming off this low point, and that obviously hasn't been the case since since that Thanksgiving drop that we had. We've never gotten above 100 on any of these other instances, and they've led to big bearish moves every time. So my expectation, again, as I told you before, is I think we've had a nice little near-term run. I think that's all this is. This is not a new intermediate rally. I don't think the intermediate line's running up to the bullish territory. I think we've hit resistance. We have much stronger resistance now than we did here in March. That's why we rallied more in March than we are now. Much stronger resistance now, sitting right on top of us. And if you look at those tweets from that I posted last night, much different picture now than coming off the other correction lows, which means that I don't think this is a correction low, and I still think we have a new leg to the downside to come to get to the 200-week moving average, to break the 23% Fibonacci level of that big bull market run, the red one on the market forecast chart. All those things I still think are to come. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section. Tell me what you think. Do you, if you disagree, especially, what drives either whether you're more bullish than I am or more bearish than I am? What indicators, what charts, what are you using that kind of steers you in that direction, and share that with the viewership down there in the comment section below. All right, so looking at the charts here going into the last few months, you can see commodities are still the big winners. The dollar is also still a big winner as it's kind of turning back up the last couple of days, and you can see bonds just are really the big loser. And today that was definitely the case. Bonds had the biggest move to the downside. When I come back here and look at June 1st, bonds really struggled. Eventually, a lot of these other, like this late drop in equities brought everything down below it. Developed markets more so than anybody. But look at this three things here at the top. This is not a very common thing, and it actually is pretty much it's about as risk off as you can get, because you can get more risk off, I guess, with commodities falling, but with the dollar and gold both rallying together shows, and then ultimately long-term bonds outperforming. They were down, but they still outperformed equities by the end of the day. It's to a small amount. Equities were down, or then bonds were down more too earlier in the day. But they have those three up there at the top. It's very rare and not common, and shows just kind of where we're at right now with the risk appetite, where risk appetite is. It's not very much. It's not very high. Risk aversion is still very, very high. Look at this move in bonds today with the jump in yields. You can see, like, because yields are, we're rolling down, the MACD is rolling down, the stochastic's rolling down. I think you're setting up for either a higher low or diverge. I don't think the MACD is going to get lower than where it got down here. So I think you're going to ultimately cross over and get a higher low point. The question is whether you'll get a higher low or a lower low here. Regardless, you're setting up for a new low. So the stochastics got to a higher point than any of these other peaks. So you have a really good, relatively bullish, at least more bullish than what we've seen. And that sets you up for a better low coming off of that divergent low point there that you had here. I think we're going to get kind of like a head and shoulders bottom is what usually ends up forming in that kind of, when you get this big divergence and you can't quite get to that old high point, you set up a head and shoulders pattern. In this case, an inverse head and shoulders. So watch for a short crossover here and then a move. There's a big gap between these moving averages. Once you start to get in that gap and with very little volume, bonds can really fill that up really, really quickly. Keep in mind, again, if you're expecting, what kind of market we're expecting to be in, bond markets are in a bear market. Like, you had the correction last year. We've got the failed bounce at the end of last year. We've been in this is a bear market for bonds. If this were SPX, we would be in full-on bear market mode. But if this were SPX, this is where we're at right now, where my cursor is. That's where we're at right now, because we're just barely crossing below the 50 and making our way to the 200. We haven't had the correction bounce yet. So that's the point where we would be, and this is the stage where bonds already are. Remember, bonds lead stocks, so you would expect that if bonds are in a severe bear market, then you would expect that stocks probably will get to that point too and work their way up. And again, what does that mean? How can bond yields fall with the Fed raising interest rates, because the yield spread's already flat. So there's not a whole lot more bond yields can rise. So bonds might not take off. They might really kind of stay low for a while here and really build out its tremendous volume node over the course of, by the end of the year, if that's how long it takes the Fed to get to that, where the bond market says it will get to. But if that's the case, then I mean, man, it sets you up for a really good move in bonds, if not by the end of the year, somewhere around that period, to take off to the upside. The dollar is another story. Remember, the dollar yen is the one that we've really been paying attention to, because the dollar yen is kind of a sign of risk aversion. We're setting up here for the same kind of thing, this parabolic peak, a consolidation, and then a new move that's not obviously nearly as strong, and sets you up for a much easier peak to fall down from, because that it's kind of harder to fall down from a parabolic peak like that on such a liquid asset class. But it is much easier to come down from a much weaker peak, which is what this would be, depending upon how it ultimately plays out. You got a good bounce. You're back above the 23% retracement. Now the question is whether it will stay. And if this rolls over again, you expect that a strong yen, and for that matter also a strong franc, relative to the dollar, would be another sign of risk aversion You can see we got to the 50-day moving average on the franc. If we end up holding here at the 17 and rolling over again, that's, you would expect that to be another sign of risk aversion when the dollar underperforms these safe haven currencies. Commodities is another thing that's been really bullish and has had a good day today. You can see there's the move up 0.5%, but you can also see too the kind of candle we got. I wouldn't put a lot of stock into that move, and I think, again, while we continue to consolidate, I think commodities will converge, right? You'll stay, where we won't really break down, because I still think there's a bigger move to the upside in commodities. That's typically how bull markets end, with a really strong move in commodities, after that initial surge. I mean, just to kind of give you an idea of just where we're at right now in commodities, we were in a bear market that ended with COVID, and we got up above these moving averages, and we've really gone parabolic. I think we're going to kind of stall here and just converge, right, where we don't really get probably won't get below that 17-week moving average. Most likely will not get to the 30. We've already done this before. And then we'll make that last late surge. Again, very similar to the correction in 2007, where commodities they didn't drop, they just converged. And then they rallied up with the markets in that failed correction bounce. And then everything rolled over at that point. And that's when you're in a bear market, is when everything is rolling over, commodities and equities included. Let's take a look at how the sectors performed today. So big risk off day from an asset class standpoint, but from a sector standpoint, where are we at? There we go. From a sector standpoint, you can see energy and utilities are your biggest performers over the last 3 months, but let's go to today. Energy is your big winner today, and you can see on the other end of the spectrum, financials were a big loser. Staples were a big loser. Healthcare was a big loser. So not quite the big risk-off pattern from that standpoint. From the others, you would think, man, we had a really big down day. But from here, you're like, well, XLK outperformed. XLU did too, but so did XLK, not really the two that you would link together. And then, energy is doing really well, which is also, again, something, when energy is the only thing doing well, it's a sign of maturity of this bull market, this long-term secular bull market. And again, another sign that this correction might be the one that ultimately leads to an unwinding of that bear market or bull market, which is obviously what a bear market is. So kind of another one of those signs that okay, once this correction ends and then we get the bounce, there's a really good expectation that bounce will fail, and then we'll roll over and start the bear market at that point, because of some of these factors that we've been talking about. All right, now let's take a look at our trade idea today, and let's take a look at Archer Daniels. Midland also had a bearish day today, and that's a little bit of an engulfing pattern, engulfing about 4 days worth of candles. The near-term line dropping out of bullish territory had kind of a little bit of a higher high, kind of a near-term opportunity here, a little of a consolidation to the upside, but it appears that we might be kind of hitting some resistance here. And then near-term line rolling back over, already down to 2.33% below the moving average, so it's already moving quickly to the downside. When you take a look at, let's take a look at some of these other charts. Let's look at the long-term chart for Archer Daniels. Again, you got the red arrow, back the red arrow. You don't have a negative differential, but it's really small positive, and it's really kind of a transition anyway still. And then you have a falling PPO that's still really high. 12.95, as you can see, is still a really, really high level relative to what we've seen in the past, especially if you go out like a long term here. There's 12.95. That's still a pretty decently high level for the last so many years. As you can see, it's really gone parabolic up to that peak that we just barely had. When you look at the 3 green arrow chart for Archer Daniels, you can see the histogram is rolled over. We got that engulfing. We closed below the 50, the 30, the 8, and the 17 all in one day. So we closed below all the moving averages, just like that. And you can see the gap between the 50 and the 200 really big. And we're like the 8 and the 17 are below the 50. Excuse me, the 30s is crossed below the 50. This happens quite a bit when you get a crossover and you get a rally kind of at the same time you get these kind of intermediate crossovers. So now you failed at the set 50-day, and now it looks to fill in that gap to the downside. You can see some of the other oscillators. The DMI, you see the negative has jumped up above 25. The positive is barely below 25. So you haven't really broken out yet per se there. The RSI and the CCI broke down from a bearish high point, especially on the RSI. When you look at the trend strength indicators, we had this bearish trend that ended, but we're still in the cloud. We didn't get back above the cloud. We're back below the blue and the green lines there. That's how close we are to getting back below the cloud. And then from a Bollinger Band standpoint, the band was so big, and you're back in the lower half of the bandwidth. So it's kind of a little bit of a fake out move yesterday. And now we're moving back down to the downside. When you look at it, from a Fibonacci standpoint, it looks like we kind of faked out into the upper half of the band of this retracement, and now we're already almost back below that 23% retracement, with not very much volume down here as you head towards the point of control at the bottom end. As you get back into the value area and work your way down, we can really get moving to the downside if it breaks. So what we decided to do was like, okay, if this rolls over like a lot of things are rolling over right now, then let's do a bear put spread. We'll buy the $80 put for July, sell the 77.5. Very aggressive, as you can see. Very small risk, and about an over 5-to-1 reward to risk ratio if it gets down to those levels. So if we really break down hard into this level, you can see how easy it would be, because there's just no volume here on this long-term chart. So because we went parabolic, it just as fast as we went up, you can go down just as fast. We get a good reward for, like I said, a very small risk. If this gets caught up in everything rolling over, as it appears, like I said, to be the case, the market may be making a new leg lower to the downside here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video below. Also, like us on Twitter and Facebook. Join our website at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.